On paper, it was one of the largest fortunes in modern finance. Account statements mailed to investors across the globe reflected a staggering accumulation of wealth. $65 billion in total claimed value, wealth managed quietly, reliably, and exclusively for decades. There was only one problem with the number. The trades behind it had never happened. For 20 years, the operation run by Bernard L. Madoff worked like a theatrical set. From the front, everything looked substantial. The architecture was imposing, the footlights were bright, and the audience saw a polished performance of consistent returns. Behind the facade, there was no building at all. The question is not how a financial genius defeated Wall Street. The question is how sophisticated markets, experienced institutions, and careful individuals spent decades looking directly at an empty room and believing it was full. In December of 2008, the illusion ended at Madoff's Manhattan offices in the Lipstick Building. Bernard Madoff confessed to his sons that his investment advisory business was a massive fraud. For years, the statements sent to clients showed steady, improbable gains. Those statements represented $65 billion in fictitious value. That figure did not represent cash sitting in a vault or currency lifted from active accounts. It was an accounting fiction, a ledger entry of gains generated by a machine that traded nothing. To understand how that fiction survived for decades, you have to look past the scale of the collapse and examine the architecture of belief that sustained it. Madoff did not build a complex financial engine. He built a fortress of reputation. Before he was known as the architect of a historic fraud, Bernard Madoff was a legitimate market pioneer. In the early 1970s, he helped build the electronic trading infrastructure that eventually became the NASDAQ. He served as its chairman. He was a market maker whose firm handled a significant share of New York Stock Exchange volume. That standing mattered. On Wall Street, pedigree functions as a substitute for verification. Madoff was not an outsider pitching high-risk ventures from an unknown address. He was an industry insider. He sat on regulatory advisory committees. When firms needed someone to execute trades efficiently, they went to Madoff Securities. That broker-dealer business was real, profitable, and respected. It sat directly alongside a separate advisory business that operated in near-total isolation. The advisory branch was housed on its own floor, kept apart from the market-making operations, and shielded by an aura of elite discretion. The mechanics of the fraud were remarkably simple. When new clients handed over capital, that money did not go into equities, options, or treasury bonds. It went into a commercial bank account. From there, the money sat. When investors requested withdrawals or distributions, cash was paid out directly from that same pool of principal provided by newer clients. It was a classic Ponzi scheme, stripped of complicated derivatives and hidden offshore structures. The most labor-intensive part of the operation was not trading securities. It was manufacturing the paperwork. Staff in the office used software built to backdate trades, selecting realistic price movements for stocks days after the market had already closed. They printed monthly statements showing modest, consistent gains across a balanced portfolio of blue-chip names. The investor looked at the statement, saw a reliable monthly gain, and assumed the strategy was working. The statement was not a report of activity. The statement was the product. Scarcity is a powerful instrument in finance. Madoff understood that people value what they cannot easily obtain. He did not chase clients. He turned them away. Access to the Madoff fund was treated as a privilege. Placing capital with his firm required personal introductions, social standing, and an understanding that questions about his split-strike conversion strategy were unwelcome. If an investor pressed too hard for operational detail, Madoff suggested they take their money elsewhere. That posture built a psychological barrier against doubt. In a market defined by volatility, losses, and unpredictable cycles, Madoff offered an anomaly. His returns were positive in almost every month. To his investors, that consistency was proof of genius. To anyone examining the mathematics of the market, it was an impossibility. Real markets fluctuate. Options strategies take losses during downturns. A fund that never loses money in a volatile market is either operating outside the laws of finance or inventing its own results. The warning went unread because questioning the returns meant questioning your own place inside the circle. The warnings were not invisible. According to the Securities and Exchange Commission Office of Inspector General Report of Investigation OIG 509, the Commission received 6 substantive complaints between June 1992 and December 2008 that raised significant red flags about Madoff's business. Analysts, competing fund managers, and industry whistleblowers laid out the arithmetic. They pointed out that Madoff claimed to trade options volumes that did not exist in the reported markets. They noted that his auditor was a small accounting practice operating out of a strip mall in Rockland County, New York. The examinations and investigations that followed did not uncover the fraud. According to that same report, the reviews were never completed with the steps that would have exposed it. Independent verification of Madoff's trading through the clearinghouses was not carried out. The complaints were received. The mechanism behind them was never tested. For 2 decades, the system sustained itself on a steady influx of new capital. As long as incoming cash exceeded outgoing redemptions, the theater stayed open. Then came the autumn of 2008. The global financial crisis triggered a wave of panic across international markets. Institutional investors, hedge funds, and private clients moved to pull capital out of everything they held in order to cover liquidity needs elsewhere. Requests for withdrawals mounted. Millions turned into billions. The pool of incoming cash dried up. Madoff scrambled for emergency loans from wealthy acquaintances and foreign backers, trying to bridge the gap between what clients wanted to withdraw and the accounts that could not cover it. The crisis did not create the fraud. The crisis removed the cash flow that had concealed the absence of any real investment activity for 20 years. The arithmetic had finally caught up to the set design. On December 11, 2008, federal agents arrested Bernard Madoff. The arrest followed the confession he had made to his sons days earlier, admitting that the advisory business was a fraud from top to bottom. The legal process moved quickly. On March 12, 2009, Madoff stood in a federal courtroom in Manhattan and pleaded guilty to 11 felony counts, including securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering, false statements, and perjury. He offered no defense, telling the court he had known from the beginning that what he was doing was wrong. On June 29, 2009, United States District Judge Denny Chin sentenced Bernard Madoff to 150 years in prison. The liquidation of the firm fell to the Securities Investor Protection Corporation, which began the long work of untangling decades of fabricated records and returning recovered funds to eligible customers. The story of Bernard Madoff is usually told as a cautionary tale about greed. Greed alone does not explain how $65 billion in fictitious value could stand in plain sight for 20 years. The fraud survived because it offered something people wanted to believe was real. It offered certainty in an uncertain world. It offered elite access, steady gains, and the comfortable idea that someone smarter had found a way to tame the volatility of the market. Madoff did not sell stocks. He sold trust. Once trust became the currency, verification stopped. The set stood for 20 years, not because the walls were thick, but because nobody wanted to look behind them.